The economy is strong. Jobs are up. Stock markets are near record highs. At least, that's what the headlines say. But for millions of Americans, life has never felt harder. People work more, yet afford less. So what's really happening? Why do people feel poorer even when the economy looks good? This story is not just about inflation. It's not just about prices going up. It's about how the entire system quietly changed. Groceries cost more. Rent keeps rising. Gas feels expensive every week. And somehow, paychecks don't stretch far enough. Here's something most people don't realize. Inflation doesn't bring prices back down. Once prices go up, they usually stay there. When inflation slows, it only means prices rise more slowly. It does not mean life becomes cheaper again. For decades, wages failed to keep up. Prices climbed higher, but incomes moved slowly, or not at all. On paper, people earn more money. In reality, they can buy less than before. This is how people get poorer without realizing it. Workers became more productive. Technology improved. Companies earned more profits, but workers didn't share the rewards.
Imagine watching your wealth vanish before your eyes, while those who understood history quietly protected theirs and even turned crisis into opportunity. The question is, which side will you be on? History repeats itself. Every major financial crisis over the past 500 years has followed the same stages. There is a period of excessive debt accumulation, followed by rising interest rates and warning signs, then a silent exodus of capital, and finally, the collapse. This video will show you how to recognize these stages, understand the patterns, and take actionable steps to protect your wealth and even profit during turbulent times. One of the most important strategies is to diversify your currencies and financial exposure. Don't put all your money in one country or one currency. Consider holding Swiss francs, Singapore dollars, Norwegian kroner, and other stable foreign currencies. Political and economic risks vary widely across nations. Diversifying reduces exposure to capital controls, currency collapses, or sudden policy changes. History shows that those who concentrated wealth in a single jurisdiction often suffered devastating losses. During the 1997 Asian financial crisis, investors who held stable currencies outside the affected region preserved significant wealth, while Spain in the 16th century shows how concentrated assets can evaporate. Allocating 20 to 30% of your portfolio in stable foreign currencies across multiple countries is a practical starting point. Understanding the timeline of these economic phases is crucial. The capital flight phase does not last forever. Historically, it lasts between 18 to 36 months. Currently, we are likely 12 to 15 months into this phase, based on foreign selling trends. Timing is everything. Acting too late can be catastrophic, while acting too early without strategy may lead to losses. For example, during the Dutch Republic's financial collapse, those who acted 6 months early preserved wealth, while latecomers lost decades of capital in mere months. Monitoring capital flows, foreign reserves, and central bank policies can give you early indicators to position your assets correctly. Liquidity is another critical factor. Cash loses value to inflation, but in a crisis, liquidity is power. Illiquid assets trap you at the worst possible moment. Historical examples demonstrate this clearly. During the 2008 global financial crisis, investors who had cash on hand bought prime real estate and blue-chip stocks at huge discounts. During Argentina's 2001 collapse, those holding cash outside the country could seize opportunities inaccessible to local residents. Keeping 10 to 20% of your total assets in cash or highly liquid assets with quick accessibility ensures you can act decisively when the market shifts.
Reducing debt cannot be overstated. High debt in a rising interest rate environment is a ticking time bomb. Each increase in interest rates makes debt more expensive to service. Historical examples include the Latin American debt crises in the 1980s, where highly leveraged individuals and governments suffered devastating losses, and the 2008 U.S. mortgage collapse, which wiped out over-leveraged homeowners' life savings. Paying down high-interest debt now and avoiding new leverage, unless strategic, can protect you from catastrophic losses. Investing in human capital and relationships is one of the most resilient strategies. Skills, knowledge, and trust-based networks cannot be inflated away or confiscated. In post-Soviet Europe, skilled professionals survived and thrived, while financial-only wealth evaporated. Globally, during crises, entrepreneurs, engineers, and medical professionals retained their value.
Investing time and energy in high-demand skills and nurturing trusted networks ensures you have assets that cannot be taken away, regardless of economic turmoil. Studying historical patterns is essential. Economic crises follow predictable patterns. Spain, the Dutch Republic, Britain, and Latin America all experienced similar stages of accumulation, warning, capital flight, and collapse. Gold has historically preserved value during hyperinflation and sovereign defaults, while over-leveraged real estate often collapses. Stocks show sector-specific performance. Some sectors consistently outperform, while others crash completely. Historical data indicates that gold in hyperinflationary periods can increase by 500 to 1,200% in real terms. Tracking debt to GDP ratios, foreign reserves, inflation, interest rates, and asset valuations allows you to recognize these patterns early. Recognizing systemic signals is critical. U.S. debt has reached $38 trillion. Foreign central banks are selling U.S. treasuries, and major institutions are diversifying. These are not coincidences. They are predictable patterns signaling the approaching collapse phase. Stage 3 is happening now, the silent exodus of capital. Historical evidence shows that those who recognize these signals early can act decisively before Stage 4 hits, giving them a substantial advantage. Following central bank reports, IMF releases, and foreign investment flows, and comparing them to historical crises will help you stay ahead. Psychological and behavioral insights play a key role. Most people fail during crises not due to lack of money, but because of fear, denial, or delayed action. Spain's 16th century default shows how panic can destroy wealth when decisive action is delayed. Opportunity is quiet. Fear is loud. Training your mind to act based on data and patterns rather than emotions will allow you to navigate economic turbulence effectively. Developing mental frameworks for calm, data-driven decision-making and maintaining historical logs for reference can improve your chances of survival and growth.
Calm, authoritative, and slightly urgent. Understanding specific assets is essential for risk management. Gold preserves value during currency crises. Real estate can be risky unless undervalued and low leverage. Stocks in historically resilient sectors outperform during crises, particularly energy, utilities, consumer staples, and precious metals ETFs. Avoid over-leveraged or speculative sectors when risk is high. Allocating 10 to 15% of assets in crisis-resistant sectors adds stability and protection. Putting it all together, you should diversify currencies and jurisdictions, maintain liquidity, reduce debt, invest in human capital and relationships, study historical patterns, monitor systemic signals, and stay psychologically prepared. History repeatedly shows the stages: debt accumulation, rising interest rates, capital flight, and collapse. Stage 4 is approaching, and the mathematics of the situation are inevitable. The question is whether you will be ready or left scrambling, asking, "How did I miss all the signs?" Surviving these transitions is not about having the most money. It is about having the best information, the right skills, and the courage to act. In the next video, we will explore 3 sectors that historically outperform during currency crises: assets that preserve wealth during hyperinflation, and assets that are destroyed completely during collapses. The pattern does not care whether you believe in it. It unfolds relentlessly as it always has. Your choice is simple: prepare wisely now or pay dearly later.